let's kind of talk about some of the key things we've discussed relating to annuities. The phases of an annuity. The first phase, accumulation, where the money is going in and then continues to grow based on that interest rate or the performance of the funds. The other phase is the annuitization phase, where they are properly turning on an income stream to themselves. That's the right way to take money out. And remember, let me tell you something about annuitization. You do not have to ever annuitize. They can just let the money grow, stay in the accumulation period. But also you can annuitize at any age, as long as you're an adult in your state, 19, 21, you can annuitize if you have an annuity. A lot of people think, oh no, it's 59 and a half. For annuitization, that 59 and a half rule does not apply because annuitization is the correct way to take money out. Okay? The parties, the persons or entities involved in an annuity, you've got the annuitant. That's when you're in the annuitization period. You're taking money out. You've got a beneficiary while you're in the accumulation period. And when you're in the accumulation period, the person who has the annuity is called the owner, not the annuitant. That's the key as to what phase they're in. Owner, when you're in the accumulation period. Annuitant, when you're in the annuitization period of the annuity. Now, based on how the premiums are invested, you can have a fixed annuity that gives you a guaranteed interest rate to grow the money. You can have an equity indexed annuity that mirrors some type of index, like the S&P 500, for example. If the S&P index is up overall, your account will be up overall. If the S&P is down, your account value would be down to mirror it, to match it. And then you have the variable annuities that are invested through the separate accounts. They purchase mutual funds, so therefore it's a security, so you must have securities registrations, minimum 6 and 63, plus your life insurance license for that. How do you put the money into an annuity? Basically two choices. You put it in as a large lump sum, single premium, all up front, one time, and then you let it grow. Or you can immediately annuitize it, turn on an income stream right away. Or you can do a periodic or flexible premium is what it's called. You put money in when it's good for you. You could put it in every day if you wanted to, every month. You put it in once a year, you get a bonus, you dump it in. Whatever comes along that you see, I've got a little extra cash here, I'm going to put it in my annuity and save it for my retirement. Flexible premium. When you start taking money out, when you annuitize, you can do an immediate annuity. You always have to put in a large single premium amount, first of all, and then you immediately, which means within the first year of the contract, you must start taking money out of it as income to yourself. That's that SPIA, single premium immediate annuity. The immediate means you immediately move into the annuitization period. Or you have deferred, which is how probably the majority, I would say, of the annuities that are purchased, they're deferred. People buy an annuity, they plan to let it sit and just grow. They don't plan to necessarily take the money out, but they want that tax-deferred growth, and the money's there if they need it at some point in the future. So they just defer, they just wait to take money out because they know they don't have to take money out. And then you've got settlement options. Now, I will tell you that there are 3 major settlement options. All 3 of them have the word life in their title. That tells you by having that word life in the title, it's called life only. That's the first one. That is based on the person's life expectancy. Let me give you an example of what that means. So you are choosing the option that is going to give you the largest payout, but you have no security for someone you're leaving behind. There's no beneficiary feature on this. You're not going to protect your loved one you're leaving behind, but you do get the highest payout. Now, I will tell you this is a life expectancy based because it has the word life in it. When you choose a life expectancy based option, you, the annuitant, if you live to be 150 years old, the insurance company would have to keep paying you. What do I mean by that? Life expectancy based, they will look at your age when you annuitize, when you turn on the income stream. Let's say you're a 60-year-old male. in this country, basically mortality on a person who is a male 60 has about 20 years to live. So to age 80. That's your life expectancy, that 20-year time period from the time you annuitize at age 60 to age 80. The mortality tables say if you're a male, age 60, you're probably going to be dead by age 80. I know it sounds a little morbid, but this is what we have to work with. So you choose that life-only option, and you get the largest payout of the money, in your annuity, and you live to age 80. That means that at the end of the year that you're age 80, they will have paid out all the money you paid into the annuity and all the interest. But let's say you're still alive, you keep living. Let's say you live another 5 years or 10 years. They will continue to pay you because you chose a life expectancy option. So that money is all coming out of the insurance company's pocket at that point, if you live beyond your life expectancy. So in essence, you won and the insurance company lost. They're paying you out of their pocket now because you lived longer than they expected you to. Another life expectancy-based option is refund life annuity. Again, use that same example. A 20-year life expectancy, age 60 male, would have life expectancy to age 80. Well, let's say you die the life expectancy is age 80. Let's say you die at age 77. You've got 3 years left before you would have reached your life expectancy. Well, in that case, this choice gives your beneficiary a little bit of protection. They would refund those 3 years of life expectancy monies that were never going to be paid to you because you passed away at age 77 instead of, age 80. So those 3 years of payments would go to whoever your beneficiary is. So you've got some beneficiary protection. It's actually the lowest payout of the 3 life expectancies. And then you have life with period certain. This is a very popular option on annuities. The period certain is protection time for your loved one you're leaving behind. It's still life expectancy based because it's life with period certain. The word life is in the title. So as long as you live, you're going to get paid. Even if you live to be 150, they're going to keep paying you. But the period certain, period just means a time frame. So you choose a 10-year, let's say. Usually it's 10 or 20 years. Let's say you choose a 10-year period certain. That means the first 10 years of the annuity payouts to you. If you die somewhere in between those year 1 to year 10, let's say you die in year 6, there would have been 4 years of payments left to get to that period certain of year 10. Those 4 payments would be paid to your beneficiary. So again, you've got beneficiary protection. Or change it up a little bit, period certain 10 years, and you, the annuitant, dies in year 12. There would be nothing for the beneficiary because you actually got your payments through year 10, and now you're up to year 12 when you pass away. The period certain ended at 10. Period certain protects the beneficiary. Therefore, the beneficiary would have no payment because you, the annuitant, lived longer than the period certain. Okay, so those are the 3 life expectancy-based options. You can cover joint life with an annuity or joint and survivor. Joint life covering 2 people on the same annuity, and whoever dies first, the benefit gets paid out. Doesn't make any difference who dies first, but at the first death, it's going to pay out. On a joint and survivor annuity, it pays for multiple people, usually 2 on the annuity, and even when the first person passes away, it still continues to pay the second person until they die. So it pays through the second death, through the survivor. Okay? Lump sum, that could be a way to take a settlement. You decide to annuitize and you say, just give me everything in the annuity and all the growth right now. That could be a very big tax bill for your client if it's a large amount of money and it's been there for a while. So all this deferred growth, when you take that out, you haven't paid tax on it. So it's all going to be taxable at your ordinary income rate. So it could be a very costly way to go. And then, of course, you could take a fixed period or a fixed dollar amount. Anytime it's fixed, it means you select that fixed period of time. You want all your money out in 5 years or 6 years or 12 years or whatever you want. You could still be alive after that. You could outlive that choice. Same thing with the fixed amount. You say, pay me $20,000 a year till the money's gone. You could be alive and have your money all paid out to you. You would have no more payments. So you could outlive that option. The two fixed choices, fixed period, fixed amount, you can always outlive.